if in 2025 you have watched hours and hours and hours of trading content on YouTube and you are still making the same mistakes over and over and over, I don't know what to tell you. The best traders in the world are giving you exactly what you need to do to be successful. In fact, my mentor said, Chris, this is why your trades suck. That was the slap in the face I needed. This is why your trades suck, Chris. Start doing it this way and you'll make money. And Steve Burns, he said, yeah, I used to trade that way too, Chris. And then I realized I want to make money. And if you are still trying to outsmart the people who have figured out the rules because you think you're smarter than them, I don't know what to tell you. You're not going to be in this game. Not at all. So here's what we're going to do. We're going to watch this video, and it's called A Masterclass in Trend Following by Jerry Parker. But before we do this, I want to share this video. It's Jerry Parker, a trend trading master, in 60 seconds. In 60 seconds, he's going to tell you everything in this hour-long video we're about to watch. But it's not going to click in just 60 seconds. But here's what you need to learn.
One of the most successful turtle traders turned hedge fund legend. In 1983, Parker joined the legendary turtle trader experiment led by Richard Dennis. By 1988, he launched Chesapeake Capital to manage client assets with a systematic approach. During the 2000s, he expanded into global markets and diversified strategies. He believes in cutting losses and letting winners grow. Parker prioritizes rule-based decisions over emotional reactions. He values consistency rather than trying to predict markets. Parker uses trend-following systems to ride long-term moves. He diversifies across many markets to reduce risk. Strict risk controls are central to every trade he makes. In 1983, he was trained in one of the most famous experiments in trading history. He launched Chesapeake Capital to manage money with the turtle principles. Later, he became a strong advocate for systematic investing. Parker managed over $1 billion in client funds at his peak. His results speak to the power of disciplined trend following. He once said, "The best trades are the ones you are most scared to take." Another core belief, you do not have to be right to make money. He reminds us that trends are your friends if you let them be. Parker believes a good system works if you follow it with discipline.
Want more stories? Smash that like.
Okay, so here's what we're going to do. In the chat, as we go, if you hear Jerry Parker, one of the greatest traders of all time, say something you've heard me say, I want you to write the word outlier, because you're an outlier, right? If you're watching this, if you have outlier software or not, doesn't matter. If you hear Jerry Parker in the chat, say something that you've heard Chris say, because the rules are consistent. Type outlier in the chat. And as we go, I'll be popping those up on the screen, because I have not watched this yet, but I know for a fact, Jerry Parker and I are going to have a lot in common. So are you, because you're learning how to do this. And you're definitely going to be learning a hell of a lot starting next week when Outlier University goes in session.
Are you ready? Let's go! Respect is earned. Respect is never given.
That's right. Starting next Tuesday, on Tuesdays and Thursdays at 2 p.m. Central Time, 3 p.m. Eastern Time, we will be conducting Outlier University. And in Outlier University, I'm going to teach you literally everything you could ever want to know about trading stocks. It's up to you. It's up to you. Are you going to come? Are you going to take notes? Are you going to listen? Or are you going to tell me that you know better than I do? Okay. Well, you know what? Let me introduce myself real quick. Let me introduce you to me, because I am just a random guy on the internet, but my name is Christopher Uhl. I've twice been awarded top 100 people in finance. I was mentored by 5 of the market wizards, the best traders of all time. I've been successfully trading since 2009, and this is where outliers like us save time, make money, and start winning with less risk together as a team. So go ahead and subscribe. That way, next week, whenever we start Outlier University, you will be watching live. Now, there are 8 gentlemen who have the opportunity to actually work with me live. You have no idea how much I'm going to teach. There are people who charge literally $84,000 a year what I'm going to teach you for free here on YouTube. So I hope you're ready. This is going to be awesome. All right, like I say, in the chat, as you see something that I have said that Jerry Parker says in this, put outlier in the chat. Let's go.
I was doing a little due diligence and looking at your strategies in preparation for this interview, and your portfolios have certainly done a nice job of being highly uncorrelated with the market.
Yeah, it's been really fun. It's almost 3 years now where the markets have just been so good. So many trends in the commodities, a lot of the currencies this year, and the interest rates, and it's just been fantastic. I can't think of a better period, honestly, the past 3 years. And so this year, entire managed futures has done really well.
Yeah, very nice. The overarching topic today is going to be about how you go about producing these uncorrelated returns using trend following, futures, and the other methods that you spent really the last 35 years, I think, studying and developing and refining. But before we get into, I think, what the meat of the discussion is going to be, I wanted to start by asking you and having you explain how you started in the business and the interesting story of working with Richard Dennis and how you got involved with the turtle traders.
I got involved in the fall of 1983 by seeing an ad that Rich ran in the Wall Street Journal that he wanted to hire traders and teach them how to trade and then give them money to manage. I mean, it was just like a dream come true. I didn't really know anything about being a CTA. I had done a lot of studying on trend following, and I heard about trend following, and I read about it. I was in my early 20s, and I thought, oh yeah, this is really good stuff. I really loved it. I fell in love with it. And it was just sort of luck to see the ad in the Wall Street Journal, send my resume in and get an interview and get the job. And it was just all this good fortune, I could never have expected. But I was somewhat prepared and ready because I had really made it my hobby to learn as much as I could about trading and trend following in particular. And luckily, that was the strategy that they used, and that's what they ended up teaching us.
So you were out of college. You responded to this ad. It was basically your first real job, would you say?
No, I was working in public accounting. So I graduated from UVA with a degree in accounting.
Okay. Funny story. I've never worked in accounting, but I have an accounting certification. So CMA is Certified Management Accountant. So I got that in common with Jerry. I think that's kind of cool.
But I definitely wanted to stop doing that, and do something more fun. And I thought that trading and it would be a great idea for me. I just needed to figure out, what was going to be my first trading job. And so I heard about this, saw the ad. And then whenever you sent your resume in, they sent out a true false test. So there was 1,000 applicants in 1983. And so we all got a true false test. And I would take this test around with me on the audits, for a week or two. I had it like maybe 2 weeks before I had to send it back in. And then on my spare time, I would read these questions to my friends and ask them their opinions and try to figure out how I could, do a good job on this test. And so when I got the interview and I went to Chicago from Richmond, Virginia, they told me that I had the highest score out of 1,000 people on this test. So that was kind of my claim to fame and probably the reason I got hired, because they wanted to hire at least a few people who maybe didn't have too much going on in their resume, except they had done well on this test. So it wasn't a precursor of any sort of idea of success, but that's how I maximized my opportunity.
What was on the test? I mean, was it investing related stuff? Was it math? What did they have on there?
It was a combination of
I do want to point out before he answers this question that it doesn't matter what your job was previously. Now, of course, he's talking about accounting, but you don't have to know any of that to be successful in the market. Not at all. What you need to focus on is the trend. I'm very sure he's going to talk about that. And even though I worked in corporate finance, Jerry worked in accounting, right? You don't have to come from a financial background, right? We all understand the concept of buying something for one price and selling it for a higher price later. So I don't want you to ever feel like you aren't adequate because you don't have the work experience of this. Not at all. And I hope Jerry goes into that point as well.
Trend following, psychology. Like one of the questions was, it takes true or false, it takes money to make money. And so I had a feeling that they were sort of contrarian minded. And I obviously answered false to that question. The obvious answer was true. So I answered false. And so there was a lot of that going on, just sort of thinking about how they may look at the markets and look at the world in a different way.
What was the training regimen like? Like, just explain the process. How long training was it? When you actually got to make your first trade? What was going on there?
So, Rich and Bill Eckhart, they were really genius people. They still are genius people. And they gave us a great, I think it was 3-week course at the Union League Club Hotel in Chicago. The only hotel in Chicago, I think, that required a coat and tie. And Rich was just like not into coats and ties. So that was kind of the funny story, is that how did his secretary or scheduler set this up at the only hotel where he had to wear a coat and tie? So, but yeah, we would just go down there, for those 3 weeks. And they would give us a training on trend and statistics and behavioral economics stuff, contrary opinion and thinking differently and how the markets worked and how trend worked. They were very, Bill is like a genius math guy, and they had quite a bit of access to computers and back testing. And this was the early 80s. And so they had done a lot of research, and they knew what worked, and they were, just feeding us daily all these good ideas and things we could have never learned in maybe any other environment. And the big untold story.
And I think that that's one of those key things where it's in the market, you have unlimited opportunities to make unlimited choices, right? There's nobody sitting there over your shoulder telling you what to do and what not to do. So that's why finding somebody who has made money in the markets and learning directly from them is so critically important, because they're going to basically sidestep all the issues that you're going to go through because they've already been through them. Okay. I have made every single possible mistake in the market. And because of that, I know exactly how not to trade. I had a light bulb moment not that long ago, pun intended, because I got to thinking about how Thomas Edison had tried and failed 10,000 times to create the light bulb. And I remember thinking, I went through that. I learned way number 1, how not to trade. Way number 2, how not to trade. Way number 3, how not to trade. And now when I go and I have a light that's out, I go get a light bulb and I screw it in. I don't have to figure it out 10,000 times because he did the work for me. That's the real difference that you need to do whenever you are looking to start trading successfully, is find somebody who's done it and listen to what they're saying. And so I'm super stoked that you're watching this channel just to start with. So let's continue on, Jerry.
Of the turtles, in my opinion, is just how smart those guys were. And we were just overwhelmed. I thought I knew human beings who were smart, and I had just never run across people like this before.
I mean, that is the one thing Jack and I were talking about before. We were wondering about the data because, like you said, this was the mid 80s. I guess you had access. They had the computers, they had the data, they had the backtesting ability, but that was, like now, obviously everyone has access to that. But you guys had probably the edge to some extent was due to the fact that the technology maybe that they had was superior than what other people had.
I think they combined that with a lot of skepticism towards backtesting. So you had amazing capabilities and knowledge from the backtest combined with, you can't really believe what this computer says all the time, and you need to take it with a grain of salt. And for God's sakes, don't try to come up with any models and rules that are so precise as if you've uncovered this holy grail. So we were...
Okay. So to give a little bit of context to that, what he's trying to say is you can backtest all day, every day, and find the absolute perfect way, right? Let's say you're doing a moving average crossover strategy, and you found that it works best when it crosses over the 7-period moving average and then under the 12-period moving average, right? That would be your entry and exit signals. What he's saying is you can overfit the data, and he might talk about it more later, but overfitting the data means that it can only work in this one circumstance, and that's not what you want. You want a like the outlier trend template, the 10 over the 20, price over the 50. Can you make more money in other ways? For sure. But it's a timeless principle that I don't have to show you the backtest because it works, right? There are certainly more ways to make more money, but that is a mathematical way to prove that it does work, because price can only go up if it's above the 10 over the 20, price over the 50. So that when he says overfitting a backtest, that's what he's talking about here, is getting it down to the fine grain of it only works in this one situation. It's like being, you may have heard the word anti-fragile. You want to be anti-fragile in your trading, meaning that you don't have to have, the most perfect entry point. You can have the basic entry point, and then you can have some sort of movement around that point. But it can't be so precise that you're never going to be able to execute it.
And we were equipped not only to handle the markets, in the 80s, 84, 85, in that area, but we were the whole point was we're equipping you for the rest of your life. The parameters may change, the specific entry and exit ideas may change, but you want to be equipped to know how to evolve properly with the markets. And this is not something we're planning on, it'll work for a while, then you'll be totally incapable of figuring out. So it was a complete, in 3 weeks. That's pretty amazing.
Were you confident when you started? I mean, when you came out of this program and you're now handling, well, I don't know, did they seed you immediately with capital?
Yeah. So like 3 weeks later, January the 2nd, we started with $1 million each. So right out of the bat, sink or swim, that we were in a different office. There was very little communication. Here's your $1 million, and you better follow our rules, and you're fully equipped, and you better not lose too much money.
You must have been nervous hitting that first trade button, I would imagine. Or maybe not.
No, I was extremely nervous. And these were also the nicest people I had ever met as well. So after like a week of trading, Rich, I think, was in Florida, and he called us all on the phone. So we were all 12 of us were in this one room, and all the phones started ringing, and Rich would speak to everybody for like a couple of minutes. And so he gets to me and he's like, okay, how do you think it went? And I was like, well, I think it went okay. And he goes, well, how many trades did you do? I said, I probably did like 10. And he said, well, how many do you think you should have done? I said, probably like 20. And he was like, yeah, that's right. Just don't let it bother you. Don't get nervous. Just do the trades. It's not that big of a deal. So he should have like yelled at me, because that was a major rule. Like the first and most important rule is do the trades. You cannot miss a trade. Follow these rules. And so right out of the gate.
Okay. So first and most important rule is do the trades. Okay. Now, why I want to stop there. You have to show up. Even if you're not going to trade today, you need to show up and confirm your market signals, confirm your stock signals, see if there is something to trade. And if there is a trade, you are obligated to take the trade. If you do not take the trade, you have invalidated everything. If you just came off a loss and you're nervous to put on the new trade, you must just throw that result out the window, because the result has no impact on what the next trade will be, right? What happened previously, what happened in trade A has absolutely 0% bearing on what's going to happen on trade B. Because of that, you are obligated to take the trade. That's what he's trying to say here.
I'm too afraid and timid to do the darn trade. But we got a lot of encouragement. It was this pretend atmosphere where we were asked just to follow the rules and do it, follow the system the way we taught you. And if you lose money, don't really worry about it if you're doing the right things. But if you start making money and not following the rules, then we are going to get pretty uptight. So it was this pretend environment for traders to nothing but positive feedback, regardless of performance. And then at one point, we all had a big drawdown and lost a lot of money in the first year. And they ended up just giving us more money to manage. So not something you should ever expect from real clients in the real world.
You mentioned the training program, but you also mentioned the true false test. And that sort of gets at a balance, I think, between, can good traders be taught? So, on one side, they're probably trying to figure out psychologically, are you equipped to do it? And on the other hand, they're actually training you to do it. So what do you think about that? I mean, do you think good traders, do you think you have to have that psychological profile in place to be able to be a good trader? Or do you think anybody can be taught to be a good trader?
Well, I think anybody can be taught the rules, and then you have to submit yourself to following rules, which I think is very difficult to do. Rich would say, I can put my rules on the front page of the paper, and I don't think anybody would really follow them.
Actually, what he said was, you've heard this before. Actually, what he said was, I always say you could publish the rules in a newspaper and nobody would follow them. The key is consistency and discipline. So I see lots of people typing outlier in the chat. It'll help me out if you put what you hear that Jerry says that you've heard me say. That will actually help make that context a little bit better. So let's continue on here.
And I think that's still true today, maybe for a different reason than he meant it. I think today people would argue and say, no, you're not only am I going to follow your rules, I think your rules are bad and my rules are better. And they may have 15 minutes worth of experience, but people.
That was me. That was 1,000% me. Unbelievably me. When I was working with Mark, when I was working with Steve Burns, when I told you earlier that Mark saying this is why your trades suck and Steve saying, yeah, I used to trade that way too. That was me trying to explain to them how smart I was. I was there. I did that. And I came out on the other side of it, but I did exactly what he's talking about.
Young people tell me all the time that my rules are no good. So they know better than me. So that's kind of disappointing.
Yeah, it sort of gets back to that Mike Tyson quote about everybody has a plan until they get punched in the face. And, it's great to have rules, but when the market's going against you, like the ability to continue to follow those rules is like a superpower for investors because, most people can't do that. Most people start questioning them and, doing different things when the market's not going their way.
It's a big superpower to have those rules and to follow them. And the one kind of unfortunate difference between this and boxing is that it goes way more than 15 rounds. And you could go years and years doing some of the wrong things. And you're just gaining confidence all the time with your performance. And yet all of a sudden, all of your problems and the weaknesses.
The bird just showed up. Look at this. Okay.
Of your system, they will pop up.
Apparently this is a thing he does because the bird he's not even bothered by that. Okay. That is hilarious.
And you will be very disappointed.
I see we're being joined by your friend on your shoulder. That's a first for us. I'll be honest with you.
I hear that a lot. She's very jealous she wants me to pay attention to her, but.
Is she a trend follower as well?
No, when I first started doing podcasts, people would, I I was very nervous about the bird, and they make so much noise. And then after a while, people would get very nervous if they didn't hear the birds. Are the birds okay? And we really missed the birds. So once again, I've got to have something to remember me by. And this is Petey.
What Rich,
Okay, that's pretty hilarious. That's super duper hilarious.
it sounded like he was very much, what was important to him was following the process. The outcome, some trades you're going to win, some trades you're going to lose, but he was encouraging, regardless of winning or losing in those trades, as long as the process was followed. And I think over time in investing, the following a process is very important, whether you're a trend follower or you have some other investment process that you follow or strategy.
There you go. As I've said before, right? There are 4 types of trades: good trades, bad trades, winning trades, losing trades. Your process determines if it's good or bad. If it's a good trade, you followed your plan, even if it's a loser. If it's a bad trade, you didn't follow your plan, regardless of win or lose. The good trade, bad trade, winning trade, losing trade, the good and bad is all about, did I follow my plan?
You follow.
That's right. I think that one of the major problems that people have with trend following is that's what it promises. And, you can't really guarantee that it's going to be successful, regardless of your back test or regardless of how long you have been successful. But it only assumes following these systems, after you've looked at this long-term back test, it only says basically that if you do this for the rest of your life, every day you do all these trades like you're supposed to, that over time, over a long period of time, you may see returns similar to what you've seen in history. But people are not interested in over time. They're interested in today. And the trades I have on right now, and it could just totally mishandle these trades this week, this month, this year, and make you look pretty silly, giving back way too much profit or having choppy periods where you don't make any money. All you do is lose. So it's the promise that if you continue to do this for the rest of your life, you'll be okay.
The funny part about that, I can't take him seriously right now with that bird pacing on his shoulder. At this very moment, he's probably managing $2 billion with a B $billion from his desk with that bird on his shoulder. Let that sink in just for a minute. So if you think that trading is stressful, this is the face of how stressful trading actually is when you're doing it right.
But that is really not on our mind. We're fighting our human nature all the time because clients are complaining and your peers are
Another one just showed up.
beating you. Oh, that's the worst thing ever. Your peers who are doing different things or maybe inferior things, they're really having a much better time of it than I am.
Many investors are sort of used to the return profiles of stocks or of like a 60-40 portfolio. They're used to getting their return over time, but being very inconsistent, having
This guy does talk super fast. I don't know why.
big up years and big down years. And I'm just wondering if you could talk about what does the return profile of trend following look like, and how does it compare to something like a 60-40 portfolio or like an all equity portfolio?
Well, I mean, I think before the great financial crisis and the Fed zero interest rate policy, that back in the day when I first started in the late 80s and with my company Chesapeake, we would have a marketing material which showed that we made more money than the S&P in 60-40, and we had less volatility, and we were more consistent with smaller drawdowns. So it was only during that recent period where we really lost out to the stock market, and the more diversification was kind of penalized, and stocks was basically the only great moves going. So hopefully we'll get back to that because we trade so many markets and we have a systematic approach. And like 2020, the big lesson for me in 2020 is just reminding everyone about how important shorts are. So much of what we see in traditional management and 60-40, it just immediately and only assumes longs. And there you have it. Okay, what are you going to do now? And here's your tools, but you have to only be long. Well, it's not going to work sometimes because you're going to need to be short bonds and short gold, and you have to have some commodities in there and some currencies. And so with that in our arsenal, with all those markets and all those advantages, we should almost consistently outperform stocks or 60-40. And maybe we'll start doing that like we have the past 3 years. But I don't know, the Fed, and who knows what's going to happen. And maybe the anomaly was prior to that where our performance was so good. But we'll see. I can't really predict what's going to happen.
You mentioned earlier that this last few years has been really good for trend following. And I'm wondering, what does a good period for trend following look like? I mean, is it a period where trends are persisting for really long periods of time and are kind of consistent? I mean, is that what a good period looks like?
I think so. And like I said, part of the issue recently, before 2020 was the only thing trending was stocks. So three quarters of our portfolio was sort of dead in the water. Commodities really hadn't done anything in a long time. The currencies either. Bonds were going up, but getting closer and closer to zero or negative interest rates. And so CTAs would not have a big allocation to equities. And then I think one of the major, in my opinion, problems with managed futures is reluctance to include single stocks. And so even if they're going to trade stocks and have stocks in the portfolio, they only did it with indices, which are not going to be as profitable as single names, trading the single names. And so that still is something that most CTAs haven't embraced in their managed futures trend following program, is adding a lot of single stocks in there to give them more diversification, more chance for these outlier moves, because that's what trend following is all about. Is
He said these outlier moves. Let's go.
Hitting the big, huge moves.
You mentioned the Fed, and do you think what the Fed did in terms of keeping interest rates artificially low, I mean, was that a significant headwind for trend following strategies? And do you think now that maybe we're going to see maybe more normal interest rates, is that more of a positive going forward?
Probably. I don't really know. People, AQR and others wrote papers as to why CTAs underperformed so much and over that period. And the answer was the lack of big trends. Obviously, you have this methodology that's totally dependent upon big moves and taking small losses and hoping that the big moves pay for the small losses. And
right, taking trades, having big wins and small losses, where the big wins pay for the losses, right?
We just didn't get them in those, except in the equity markets. But I don't know if I could blame it on the Fed, or I don't know if we've turned the corner. I know for me personally, I have added more equities and more stocks, single stocks, to my portfolio. So if stocks become the only game in town and the only big trends again, I'm going to not perform as bad as I did. I'm not saying I'll do as well as I would like, but at least I'll have a meaning.
Okay. Nico, that's a great question. Do you believe the turtle rules work at present time? Why isn't everyone a millionaire? The reason everyone isn't a millionaire already is because they can't follow the rules. They can't. Right? Because how many times have you logged in your platform? You bought a stock at 100. Now it's at 101. You're like, oh my God, give me. Right? And you take the trade off right away. But that same stock that went down to 99, you're like, well, I'll let it ride. And then it goes to 97. I'll let it ride. It'll be fine. Has to go up from here, right? It goes to 90. Well, now's where I should buy more, because then my average price will be 95. Makes total sense. Even though I'm now doubling down on the loser, it makes total sense. And it goes down to 80. You're like, frick. If I had only kept my plan and got out with the $1 loss, right? Because now you had the $1 win and you have a $20 loss, and you even doubled up on that loss to make it worse before you finally got out. That's why everybody's not a millionaire, because that is normal. That is normal. What we are doing is abnormal. There are two distinct paths in trading. Follow the path that everybody else is taking, the 90% of people who blow up 90% of their accounts the first 90 days of trading, or do the exact opposite. And it's hard. It's so hard. I'm telling you, you may not have experienced this before, but holding on to a winner, letting the trade get bigger and bigger and bigger and bigger and bigger, that is way harder to me than taking a loss. It is so much harder for me to watch a trade go from 10% gain, 20% gain, 50% gain. I had one that went 377% gain before I finally closed it. 377%. Do you know what it's like to sit there day after day after day, watching that green number on the screen, thinking, oh, I don't know, maybe I should take it off today. Oh, what should I do? I guess I should just follow my plan. Day after day after day that goes by. And then when you finally get your exit signal, do you know how good that feels? You watched it go from a little bitty baby to a big old grown up trade, and you got to keep a 377% profit. Does it happen often? No. But when it does, that is so much harder than just cutting your losses. Moving on. I'm telling you, if you haven't experienced that yet, maybe I hope one day you can, because that is so incredibly hard.
Meaningful allocation to equities and those particular trends.
Which futures markets do you trade? I mean, it seems like there's a lot of futures markets that are out there. So, I mean, do you try to just cover the major asset classes, stocks, bonds, commodities, that type of thing?
I do. I trade as many currencies as I can find, and commodities as well. lots and lots of interest rates, ETFs. I branched off into not just interest rate futures, but interest rate ETFs that don't have a future associated with them, like muni bonds and high yield and tips, mortgage backs and things like that. So that's my big goal, is to find as many markets as I possibly can and to trend follow. So I'll have just a gigantic portfolio. I'm taking all of these really small bets, but still 5 or 10% of my trades will be responsible for all of the profit in any given year.
This is something I sort of struggle with myself. And we talked to Andrew Beer about this idea between simplicity and complexity. So, on one hand, you'd probably want to access as many futures markets as you can, to try to find things that might be profitable for you. But on the other hand, maybe like you can get the major moves with like less markets, you're accessing. How do you think about sort of that balance between complexity and simplicity?
Well, people are going to think that I told you to ask me this question, because this is my favorite question. And it's really, in my opinion, I have people disagree with me, but
sorry, it's so hard to listen to him with the birds on his shoulders. Listen, what he's telling you is so valuable. You have no idea how valuable it is, but it's hard to focus with the birds.
It's the difference between managed futures and trend following. And in a nutshell, trend following, managed futures CTAs don't practice enough trend following for me. It's trend following, but it's a different kind of trend following that they have come up with, most of the larger firms. And so, the cliche is take small losses and let profits run. So everyone takes small losses, but they don't really let the profits run. And so
I don't know if everyone takes small losses. I think most people take big losses. But to what he's about to say right here, letting the profits run is hard. Maybe I just said that a couple of minutes ago. Let's see.
Everyone takes small losses, but they don't really let the profits run. And so if a market gets too volatile or the correlations get to be too high, then they start scaling back these positions. And so they're not really allowing the portfolio to be dominated by an outlier trade as much as a big sector move. So this makes it very easy for Andrew to replicate 20 CTAs, because
okay, let's go back just a moment. I got distracted by the fact that he said outlier move. Hang on.
Then they start scaling back these positions. And so they're not really allowing the portfolio to be dominated by an outlier trade.
Letting your portfolio be dominated by outlier trades. I've talked about this before, and you may not have picked up on it, but it's what he's telling you right here. When you log into your portfolio, you should see winner after winner after winner after winner after winner after winner. You should be so used to winning. We get so used to winning, it gets boring. It's amazing. It's so tremendous. It's like Donald Trump taking over America. We get so much winning, nobody can even describe how much winning there is. But jokes aside, that's what it should be like. You log in your portfolio and you're good on everything. And if you see something that's not working, you bounce it out and then you replace it when something else shows up, and you keep on winning and winning and winning and winning. I know I sound like a YouTube scammer right now. I know I sound like a fake guru. But the moment that I realized, oh, this is what it's supposed to be like, that changed my life. When I log into my broker account, green, 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 all the way down. That's what it's supposed to be like. And in markets like in 2025, right? It's supposed to be like you sit in cash and don't F up. So let's get back to Jerry.
As much as a big sector move. So this makes it very easy for Andrew to replicate 20 CTAs, because they're not really making a lot more money on the gilt and the yen and the British pound like me, because these other managed futures type CTAs have scaled those trades back to make them less volatile and less scary. And I'm just letting that thing run like an old-fashioned trend following. And it was a small trade when I put it on, but now the volatility is so large and the moves are so huge that it's become kind of a major impact on my portfolio. And so,
like that 377% gain, right? I put it on, it was little, and I let it run. And when it got to a 377% gain, it dominated my portfolio. Exactly what he's saying.
This old school trend following is just not practiced by many of the managed futures CTAs, the large CTAs. So I came up with this idea. Well, that's managed futures. And then I want to be a trend follower, and they're much different.
This sort of gets at my next question, because I wanted to ask, like, how do you think about weighting things within your portfolio? So in other words, if something is running, how do you think about like when it's too much? I mean, do you think about, if you've got your stocks, bonds, currencies, and commodities, do you think about like each one of them should sort of be like 25% of your portfolio and you don't want them to get bigger than that? Or how do you think about that process?
I think about it in those terms. That's a fine way of looking at it, but only when you set up the portfolios. Maybe of those four sectors, you have your initial weights for your trades to be 25% each, and then you split that up depending upon how many markets are in that sector. And so when you first put the trade on, you are going to size it based upon inversely to the volatility. So each trade bet is kind of the same bet. You're going to risk the same dollar amount. You're putting on.
Is he talking about position sizing? What Chris talks about all the time, based on volatility?
The same kind of position. You need to put on 50 S&P to equal 5,000 euro dollars. But based upon the contract size and the volatility, it's an equal bet. And so I use that
an equal bet. Okay, let's shift gears slightly over to the position sizing spreadsheet. So if you don't have this, we have it available in our Discord. Position sizing spreadsheet. Okay, you can put any stock on here, any stock you want. It will calculate the formula based on the volatility of the stock itself to give you the exact same size position bet. Wow. It is crazy. Isn't that funny? Somebody who manages $2 billion does the same thing we do for position sizing.
Money management scheme to normalize my losses. But then once the trade turns into a trade and a profit, let's say, I just let it go. And I don't try to manage that anymore. The trades all start out with the same risk and the same expectation. But as they get going, these handful of 5 or 10% of your trades per year are going to just be outrageously large and dominate the portfolio. And so this makes people uncomfortable. And this is why
that's what I was saying. It makes people uncomfortable to have these open profits.
Clients like it when the larger CTAs say, hey, let me scale that back some, let me vol manage and correlation manage and make it smoother and easier and more palatable type of trend following. And I think that's how it got really popular. And that's why those guys have a lot of money under management. It's just a bit different from trend following. And it has its pros and cons that don't really get talked about, but it's not, if it was just all one way, I would do the same thing, but I sort of chose to do something different.
So you won't, no matter how big a position gets, you won't scale out of it. You'll just wait until the trend reverses and then you'll close out the position.
Right. I mean,
sounds like me. Sounds exactly like me, right? I get my position size. I figure out how many shares or how many options that I'm going to put on, and I put it on all at once and I take it off all at once. Funny.
I have 4 different trend following systems, and I'll sort of scale out on each one of those, but I won't just reduce the trade based upon its increased volatility or its increased correlation to the portfolio or the other markets in its sector. I'll just hold on forever, and it will get very uncomfortable, but it just has a tendency overall to make more money.
It seems like there's a lot of different indicators you could use to define a trend. I mean, how do you think about defining, whether something's in a positive trend? I mean, is it a composite of a lot of different indicators you use?
Oh my gosh. If he says 10 over 20, price over 50, I will take my shirt off. Okay. Which I would not do otherwise. But if he does that, I will take my shirt off and it'll get weird.
No, it's one indicator. Like I said, I have 4 different systems, and I usually the breakouts. So I just look at different breakouts, 100-day, 120-day, 150-day, something like that. And I do breakouts on the entry and the exit. Also have a stop loss. I think it's not crazy important to do a back test and over optimize to figure out exactly where these parameters should be. Just trading a broad range of parameters is a good idea. Not too short term, not too long term. And then, but the main thing that having all of these, this strategy that has its rules and has its parameters, it just forces you into being very consistent and disciplined and handling trades the same way each time. That's really the secret is, are you going to handle these trades the same way every time for the rest of your life? And if you do, you'll get your fair share of the profits and you'll eliminate a lot of the randomness of discretion.
How do you think about the process of deciding?
Okay. Thankfully, I got to keep my shirt on. I don't want to scare away the 3 ladies who actually watch this channel.
One of the things we always struggle with quantitative strategies is, you've got your process and, you want to follow your process for the long term, but, sometimes over time things do change in the market and you have to sort of change your process. And I'm wondering, a lot of people have said, like in the wake of 2020, the market has maybe sped up some. So I'm wondering if maybe you would think like shorter term indicators would be more important now than longer term indicators. But how do you think about that process of maybe evolving the strategy over time?
I've definitely had to evolve a bit. I know in the late 90s, we came to the conclusion that the shorter term trend following was the way we practiced it. So the turtle method, nothing very sophisticated, that sort of had run its course. And then we gravitated over to a longer term holding periods, 200-day moving average, 300-day moving average, 100-day breakouts. And that was a very good thing to do, because not only has it worked much better since then, but when we did the research, those longer term parameters had always been just fine. They had performed just as well as the shorter term. And I don't really see any indication that shorter term works better than medium to long. I like the long term, and it's worked really well. I think that people,
And
if
I want to stop him here and just say the point with what I would say about this is he's created a plan, a strategy, something that works for him, and he's not listening to what other people have to say. He's doing what works for him. And that's why I preach that all the time. Figure out what works for you and just use that. Don't listen to anybody else. Everything else is noise. Even me, I'm so much noise.
evaluate systems in a different way. For instance, as I was saying earlier, if you didn't make enough money on a certain trade, the system overall is very profitable. There's no indication that it's regressing. And but look, I don't like the way it handled wheat. It gave back too much profit. So let's figure this out. Let's add something. Let's change something. So I don't really look at it that way. I think, but I do think over time you have to evaluate to make sure that when you look at all the trades and all the net performance, that you want to choose these parameters that allows you to stay in these long-term trends that last for a year or two. And then that's pretty easy to find those parameters. You just don't get out. And so, but the problem is you also have that same parameter that keeps you in. You don't want it to keep you in too long. So that's what we get paid for, is to straddle that line of don't get kicked out too quickly. You got to still be long crude, still short the bonds, still short the yen and the pound. But on the other hand, when these things turn around, and they will, without warning, you don't want to give back too much profit. And so that's the dilemma, and it's really difficult.
Yeah, that idea about the individual line items you're talking about, that's something we talked to Andrew Beer about as well. This whole idea that investors like
He's speaking so fast, I can barely understand him.
to pick apart, their portfolio or their strategy. Like you said, individual positions aren't all going to be correct. But also when people think about like integrating trend following into their portfolio, it's the same thing. Trend following helps in a portfolio context. And, people want to pick out the bad years of trend following and say, oh, that's sort of an eyesore this year. But, and then we have years like this year where it's doing exceptionally well, and if you don't keep it in during those other years, it doesn't. So this idea of thinking about everything in a portfolio context, I think is really important.
Definitely. Because like the computer will tell you how to trade, and you would think that people would just say, well, fantastic, I'm just going to do what the computer says. But we have a tendency not to do that because it's just too painful. And we want to improve it. Let's improve this particular period or this particular year. And then, of course, what happens is when you try to do that, it screws up everything else. And on some of these trades, like I have had, my parameters would just give back way too much profit in natural gas, wheat, and a handful of other markets. But then all of a sudden, because I continue to use those parameters on all the other markets, it just allowed me to make a fortune somewhere else. So maybe in 90% of the trades, they're not handled optimally, but that pays for itself because on that one trade every now and then, that just makes a killing because I was longer term or something like that. So it really is a psychological, difficult game to look at it in those terms, because all of us, regardless, we're just really very concerned about what's going on right now. We're like children.
Yeah, that's right. How do you think about investors should think about integrating trend following into a portfolio? So, I was listening to you on the Meb Faber show, and you talked about this idea that, people kind of think about, all right, I've got my 60-40 or I've got my long only, let's take 10% and put it in trend following. But you were talking about this idea that maybe trend following should be the core, and maybe this other stuff should be the satellite that people put around it. So can you talk about why that is?
Oh, for sure. I think so. I think what investors need more, what stock people who invest in stocks and bonds need more than a small allocation to CTAs and trend following is to have their stocks and bonds trend followed. So I think it's fine to have a little bit of long only, with no stop. I mean, I don't think it's possible for a CTA to have as bad a performance as long equities. It's an 8% return, 50+% drawdown.
Okay. So what he's trying to say here is he doesn't know how a CTA, so a managed futures trader, could have trades as bad as the overall market does on average. Okay. That's what he's trying to get across here. 8% returns per year, 50% drawdowns. If you're managing your money, if you're aggressively defending your money, shouldn't happen. I think that's what he's about to say.
Because we have the trend, because we have all these different markets and asset classes, and we do shorts, it's just almost impossible to find something that's going to work that poorly. So
I love it. It's impossible to find something that works that poorly when you are following the direction of the trend, up or down, long or short. It's really hard to find something that works as bad as the market in general. Now, that's a big statement. That's a bold statement, because most people bet their hats on the market. I mean, I would bet 95% of the people bet their hats just on the market. Buy the market, buy the index, buy the mutual fund, and never look at it again, right? He's saying you would have to suck so hard to get the returns that the market does. That's kind of sobering, isn't it? That's pretty sobering.
Really, you just can't beat over the long run trend following all these different markets. And with that small losses and the trend component, you're long sometimes, and when it switches, you go short, and you have your exit, you have your rules, you're systematic, you're disciplined, massive maximum diversification. It's just impossible. You really have to have a period like we've had where stocks just do outrageous things and CTAs suck so bad that where it kind of looks like the trend following is inferior. But I'm pretty confident that we'll revert back to what it was prior to the great financial crisis, and we'll see again all the benefits of what CTA trend following can offer.
Are there certain asset classes where trend following works better than others? We had Wes Gray on the podcast, and he talked about how it works really well in bonds, or it seems like commodities are prone to these super cycles that would work really well with trend following. I mean, does it work across the board really well, or are there certain asset classes where it works better?
Good question. It's both. Yes, I think that of course when you
Georgia nailed that on the head, right? All stocks are bad, and he's probably not going to say something like that, but to that point, all stocks are bad. All markets are bad, but every once in a while they act right. And that's when you're trying to ride them is when they're acting right. Don't force it otherwise.
When you do the back test, you will see certain markets and asset classes do better than others. Someone's in last place and someone's in first place. It doesn't mean anything for the future. There is nothing that's saying, aha, now we can trade, I don't know, stocks more or bigger or current commodities bigger or something. No, it means nothing. We hadn't made money in short interest rates since the 80s, and we hadn't made money in the currencies and the commodities in a long, long time. And all of a sudden, the CTAs are the only ones dumb enough to continue beating their head up against the wall in these sectors and doing those trades that hadn't worked in a long time. And boom, there are the trends. And of course,
boom, all stocks are bad, all markets are bad, but every once in a while they act right.
Of course, we're going to do it. That's how we were trained and raised, and we're going to do it. I think when you do these back tests, there's a math reason behind it as well. When you do these back tests, the most important thing is to have a sufficient sample size of trades. And you want to look at 40 or 50 years worth of data and hundreds of markets and collect, thousands of trades that you can say, okay, I've looked at 5,000 trades. This makes money. This is what it has looked like in the past. I'm sure the future will be different. The fundamentals, what's going to happen that's going to generate similar profits will be different. But I feel comfortable going forward with this large sample size. And the only way to get this sample size is to treat all the markets the same way, as if they were the same, as if it didn't matter, as if they didn't have their own personalities, which they kind of probably do. You treat the longs and the shorts the same. So you make all these compromises that most people would find uncomfortable just in order to get this sufficient sample size. And then you're off having to treat everything the same, with the same parameters, the longs, the shorts, regardless of historical performance.
I want to go back to the the risk mitigation or the stopping out of something, because I think you hit on something pretty important. You said, you are in an asset, you have nice gains on them, but you don't want to give up too much of those. You don't want to give, all those gains back, but you have to balance that with, not stopping out of something too quickly. So is your methodology something breaks trend and that's when you sell, or do you have like a stop loss based on the volatility? Or what are you actually doing to stop out of something?
Well, initially, it would be limiting the loss to a small amount. And so that stop loss is going to, that would be a closer price to the entry than the trailing stop. So the trailing stop is going to handle the profits, and then the stop loss is going to keep those losses small.
Right. So want to jump over to the slides real quick. Trailing stop being the 10-period EMA. That's what I use. Of course, this is going to be different. And then half an ATR from entry is my stop loss. They have two different functions, right? A stop loss is there to prevent you from going bankrupt, right? A stop loss is there as an insurance policy to get out of the way. A trailing stop lets you stay in the trade for as long as the trade is going, right? As long as the trade is going. And then once it crosses under that, that's the time to get out. So I'm curious to see if he reveals what he uses.
So once again, it's just going to be a breakout strategy. And it's really just going to be, it made a new low, it made a 100-day low. Okay, we're out. System 1 is out. System 2 makes a 125-day low. Okay, system 2 is out. And then if the market goes back to the highs, well, 3 and 4 are still in, and we got to get back into 1 and 2. I think the hardest thing for traders and human beings in general is not to get out of profits too quickly. And I don't want to give the
That's what I was saying earlier.
wrong impression. Like, I'm not really evaluating these trends and evaluating the system on a daily basis. No, I did my research maybe a long, long time ago. I've decided on these parameters, these breakout entries and exits, and I'm stuck. I'm not going to do anything. And so when it does give back too much profit, I'm just going to sit there and say, oh, well, I'm following my system. It'll work out better next time. You can't predict these markets. It looks dumb, but I wasn't dumb because I was just following my system. But I determined how I was going to handle all the trades like years ago when I set up the system, and I committed to sort of following it. The temptation is to, let's call up the programmers. We need a new rule. We gave back too much profit. So instead of the 100-day low, let's add something else that doesn't make it so painful. And of course, you can probably see where that leads you.
So I kind of sort of understand it more now. You have it would be like envisioning 4 different quadrants or 4 different boxes. And each one of those boxes is using a different trend following system. And so you get this diversification of different signals essentially across, the various asset classes that you're buying. And to your point, some of them might control to the downside a little bit tighter, where others are going to let it run a little bit more. And ultimately, you're saying it kind of balances out because there are multiple different signals. All of them probably work over time, but they don't always work all the time.
Yeah, they make about the same amount of money over time. And so you're just trying to diversify your entries and exits. You asked me earlier about trend and how do I define trend. So system 1 has its own way of defining trend, and system 4 has a different way of looking at trends. System 1 can be long, system 4 can be short. I mean, it's rare, but it can kind of happen. And so we're not really saying like the trend has changed. System 1 is saying it has changed, but system 2 says, no, I still like this trade. And it's right. If you follow system 2's rules, it's going to make the same amount of money over time as system 1, but you have to follow their individual rules. They're just going to be different positions sometimes. And so it's really this probability game, and all the games are positive, and you win in all of the games. You just kind of win at different times or in different amounts.
You had mentioned.
Okay. I want to take just a moment to talk about that, right? The objective here is to have more money in your account than you did yesterday, but we don't know in what order we will get that money, right? You may find that your biggest trade comes in January, and the rest of the year are small losers, small winners, right? And that would suck, but that's part of the game. You may find that you make no money for 3 months, and then in a 2-week time frame, you make more money than you made in an entire year at your day job. That can happen. Okay. We don't know the distribution of these gains. We don't know at what point we will be assigned gains or losses. And we don't know the magnitude of how big the gains are, but we should know how much risk we're taking no matter what. So I really like that point. We don't know what the outcome will be, but we do follow a process.
Mentioned that you are doing individual stocks within the portfolio. And I'm guessing it's the same, it's the same methodology, same trend following system or quadrants, but is there, I guess it's probably, I know what your answer is going to be, but is there anything else going, like, how do you define, I guess, the universe of the stocks that you're choosing? Is it just, these are the ones that are exhibiting do you have a set universe, like the largest, 500 companies, or are you all cap? And because there's obviously thousands of stocks. So I'm wondering how you get at the top stocks in the portfolio.
Yeah, well, I do it the same way that I handle the currencies and commodities and interest rates. And that is just focus on liquidity, number 1. Everything has to be relatively liquid.
Never heard that before.
And then number 2, choose markets that can add a bit of diversification. So with currencies, commodities, and bonds, especially if you're just doing futures, that's what futures traders, managed futures people do, then those markets are kind of chosen for you by the exchanges. And so you're very happy just to trade 55 commodities and 50 currencies and 30 interest rates and 30 indices. So it's all done for you. There's no anxiety. Oh my God, but if you start venturing over into stock land, why are you doing this? It's so stressful. How do you choose? What if you don't choose the right ones? Well, we don't think about that as it relates to the other sectors. We just trade them all because they're all kind of liquid and they all offer a bit, maybe just a slight bit of diversification. So in stocks, it is kind of, you're starting from a clean slate. You have to figure it out yourself. So I do the same process. I look at liquid stocks and I try to look to see which ones can offer more diversification. And it's pretty easy and it's pretty fun to put together a single stock portfolio because there's so many interesting companies doing different things to choose from. So from a qualitative and a quantitative point of view, you just choose 50 of them and just let it go and don't really worry about it too much. But no CTA would ever trade the dollar index only, or they wouldn't trade the Goldman Sachs commodity index, or a bond index. But they seem for some reason perfectly happy to trade all these stock indexes, which makes no sense. So hopefully one of these days it'll be a big advantage.
So Jerry, interesting. So he trades futures, and futures have an unbelievable amount of leverage. I mean, you can get like 100x to 1 leverage, something like that. I'm curious if he talks about if he does any sort of leverage on individual stocks, and if he does, mark my words, he's going to say he buys deep in the money long calls and deep in the money long puts. You watch.
Advantage for CTAs to.
Oh yes, bag holder bingo tab. I pulled this up. I made ChatGPT made it. I was like, I want to go through this. And I was like, wait a minute, he's not going to say any of this. But there will be a video in the very near future where we get to do this. Just teasing that video.
Capture outliers in the stock world like they do in the other markets as well. But I'm not holding my breath, but maybe one of these.
Well, yes, there's that chart that floats around Twitter, and it's based on some academic research that shows like the return, and it has it broken out like it shows a return of like stocks based on deciles or something like that, and how all the way to the right is like huge returns, but in the middle is like a lot of low or negative returns. Basically saying that in the stock market, a lot of the returns come from the right tail, the Amazons, the Walmarts, like those stocks. So if you can find those stocks using trend and stay in those stocks, which that's not easy to do because a lot of those stocks obviously have large declines, but if you can find those stocks, that's where I think the real winners are in the market.
Oh yeah, that's a very good point. But I think I might disagree with your conclusion there, because basically I know the guys who wrote that initially, it was my friends, and then other people have written about it as well, about that 4% of the stocks make up all of the gains in the stock market. But that is buy and hold. So that is not trend following. So with trend following, 96% of the stocks probably make money. And so I just made that number up because it's because of the 4%.
Might be a little high.
No. I think it's almost impossible to find a market that doesn't make money.
Just haven't had a market to do that yet. I mean, there were a couple opportunities this year to buy some puts, made a little bit of money on them, lost a little bit of money on them. But I mean, the market's been in this huge bull run for ages. Like, who's buying puts when the market goes up at a 45-degree angle, right? Not me, not this guy. Certainly not Jerry Parker.
Money and trend following. If you look at 30 years, right? So, I asked my friend who wrote that, Eric Crittenden from Standpoint, and when he was working at Blackstar, they wrote this paper that started it all, which was this trend following work in stocks. And so the conclusion was, yes, it does. And so I asked Andrew one day, I said, Eric, I said, hey, have you ever run trend following on stocks that went out of existence? So, you got the survivorship bias. And I said, hey, I don't even believe in survivorship bias with trend following. So much so that I'm going to ask you, have you ever run trend following your systems on the stocks that are not in the database anymore? And he said, yes. And I said, well, how much money did they make? He said they made about the same amount of money as the stocks that are still in existence. I'm like, yeah, because this is another problem with 60-40 and assets, putting, this traditional way of building a portfolio is it's long only. And what can you include? Well, maybe gold, maybe now Bitcoin, because now Bitcoin has had a run, and buy and hold, it makes money. Whereas with trend following, you can put everything in. Not only does it have a good impact on diversification and risk, but all of the markets make money. They all will make money if you overlay trend following. It's very rare that that's not the case. And so, it doesn't matter which stocks you choose, just like it doesn't matter the commodities and the currencies. Trade them all.
I think what he's trying to say in words that I can relate to is the 10 over 20, price over the 50. The trend exists in all stocks, right? We can go to Tesla, we can see a trend up, we can see a trend down. We can go to AT&T, we can see trends up right here. We can go to the SPY, we can see trends up, we can see trends down. We go to SoFi, we can see trends up, we can see trends down, right? This is universal principles. The difference in what he's talking about and what most people do is that they hold on to a stock and they watch it go down and down and down. And then they look at the market and they're like, oh, trend following doesn't work. Bro, you trend followed that shit all the way down. Do you realize what you did? You trend followed it like crazy. Just the wrong direction, bro.
Small or trade a smaller portfolio. There's pluses and minuses. But the fact of the matter is, almost every single one of them will add profits to the portfolio and act as a diversifier. It's a beautiful world.
No, I think I'm glad you sort of went there because I think that's a good distinction. You know, trend following and buy and hold, very different. I wanted to. Do you think it's gotten more? Let's kind of chunk out the last 20 years with trend following strategies and CTAs. Has it gotten more or less competitive? Would you say, from your vantage point?
I think more competitive, definitely from a business point of view, raising assets. The European CTAs came in with a lot better business models and more sophistication, and raised the bar and started looking like more professional and more institutional worthy. And so I started out in my, in the basement of my house with a telephone and a quote machine, and started managing a lot of money pretty quickly. So that kind of stuff doesn't happen very often now because it's more institutionalized and less the way it used to be. Small people have a hard time,
Do you believe that because it's more competitive that there's maybe less of an edge, or is it? Because I would think the last up until last couple of years, it was obviously tough to be a CTA and using trend following. I mean, they had kind of a tough decade there, like to your point, from the financial crisis really through 2020. And so you would think that maybe some of that competitiveness would have gone away, but I mean, maybe not. But what's your view on if it is more competitive? Do you think it's bad for returns or no?
I don't know. I can't really think of a good answer other than I think that the larger firms have different things that they have to do to appease their clients and to gain more assets. And I think to some degree, the smaller traders and people who just want to have fun trend following, it's something you can do with your stocks and your ETFs. I think it sort of less is more. The less you try to add to more of a traditional trend following, I think the better off you're going to be. So to some degrees, if you don't have the capability to over optimize, you're not going to over optimize. I hate to be critical, but I think to some degree there is quite a bit of research being done, and research is one of my lessons about doing research over the years is we would frequently zig when we should have zagged. I remember changing our systems one year because we had such a bad year. And so we went in and we were like, man, we really got to change them around and change our parameters and change some of our philosophy on how we're going to attack these trends. And so we were programming the computers, and I started going into the guys' offices, and I'd ask them like, you ready to implement the new systems yet? And they're like, yeah, we're ready. But let me just tell you that the old systems are now doing a lot better than the new ones. So this is, of course, you can't predict, and you try to make these changes, but there's a cost to change. Because what is the most important thing? I said, don't change. Do the system. Don't. And so whenever you make a change, now you're doing something different. If you just did something different discretionary, everyone would tell you that was wrong. Well, I didn't do this trade the right way because I just didn't feel like it. Well, everyone's going to tell you, well, that's wrong. But if you go in and you make changes with your fancy computers and software, it's still a change. So there's a cost to that. I'm not saying you don't do it. I'm just saying it could backfire for a while.
That is the sign that the strategy is about to turn, is when you get their computer programmers and they're trying to change things. Or I like to say, when certain clients start calling me, it's usually we're much closer to the bottom than we are where we were maybe a few months ago. So,
oh, for sure. Yeah. I've had clients call me up all throughout my entire career and basically tell me, you're never going to make money again. I'm like, okay, we don't get a lot of respect.
How do you think about, because your strategy is so uncorrelated with the markets, and there will be times like any investment strategy that it's going to be trailing a long only equity strategy or maybe some other investment strategy. How do you think about managing the behavioral risk with clients and making sure that they can get the most out of what you're doing for them? Because the worst thing you want to do is bring on a client, they invest with you, they lose money, and then they capitulate and they sell out. They're not there.
And wasn't the best place to stop the video. Sorry, that wasn't very flattering. But a lot of people, right? They'll get excited and they'll buy in at the top, and then things don't go right, and then they get excited and they sell out at the bottom. Human psychology. And that's the same thing with asset managers, right? When you post a good year, people come flocking to you saying, hey, you had a great year, make me money. And then the year is not so great so far, maybe 6 months down the line, and they're like, where's all my money? And you're like, it just hasn't worked out yet. And they're like, well, you don't know what you're talking about. I'm going to withdraw. And then that's probably like the exact bottom where it goes up from there, right? That is nearly identical to what's going on the fear and greed that we measure on everything. And when I tell you, watch for when it peaks for big pullbacks, it's clockwork, right? It's human psychology. It's why this on the market breadth matches the market cycle over and over and over. Because when people are at their most fearful, they're screaming sell. And then when they're at their most euphoric, they're screaming buy. And that goes in and out of, your broker account. That goes in and out if you're going to have a hedge fund managing your funds, right? There's nothing different from this to what you've experienced, to what the market experiences, to what Jerry Parker's talking about right here, because it's just human psychology.
There for those winning periods, and so trying to get them there. How do you go about managing that with your investors?
Managing it with your investors and with yourself. It's a highly emotional to to see redemptions. I mean, it could be the smallest redemption, and you're just like, it's just negative feedback that you don't need and you don't want. I want people to like me. So you can make it very personal. Like, oh, they don't like me anymore. They took their money away. And so, I started reading a bunch of years ago about the dimensional fund advisors. I'm sure you know DFA. Yeah. And so I was just intrigued by their marketing strategy. I think it was something like, we refuse to sell to clients directly. They have to go through an advisor. And the advisor has to come to Texas, I think is where they are, and they have to go through our training program. And it was like, we want them to breathe and live and believe like we do about small cap equities. And we don't want people who are going to be taking money in and out. And I think they have been incredibly successful with trying to convert people into their worldview on investing. And I think that's exactly what CTA trend followers should do. It may mean you're going to have a small business and you're not going to manage billions of dollars, but it's just fine to manage a couple $100 million and have a small business, 100 million or 50, it's whatever it is, but have fun and do it with like-minded people who love you and who love what you do, and they believe in it as much as you do. When I was in my 20s, I just read about trend following, and I had no mentors until I went to Chicago, and I thought it was the greatest thing in the world. I understood the basics, and I thought this is objective, and it is, are the big winners going to pay for the little losers? And I have just been more in love with it every day since I have been doing it for 39 years. And I have a few clients who feel the same way. And so that's how you build a good business and a good lifestyle, is hanging out with people who like you and like what you do. And they're out there. There's not that many of them yet. We need more.
I like hanging out with you guys. You guys are why I do this, right? I don't have to do this. I could disappear and you'd never see me again. But you guys make this worth doing. So thank you.
A couple of years like this year, you'll have more. Hopefully their timing's good still. What about what's your view on incorporating Bitcoin or cryptocurrencies as an asset class? Do you look at that at all, or do you kind of are you staying away from that stuff?
No, I liked it. My initial response was positive. I think it's kind of funny that it's the only ETF that is, the SEC says it's only safe to trade to have an ETF as long as it's in the futures markets. I think it's kind of funny. I don't think when it first came out and I started hearing about it, I knew how to set up a Bitcoin account. I still don't. And I think for old guys like me, hedge fund people, when the futures came out, we were really thought this was pretty wonderful. And so I've traded those futures in Bitcoin and Ethereum since they've come out. And we've had a few big trends. So it's been nice. And they're the perfect market because they're uncorrelated. And it's just what a systematic person needs, which is don't even pretend to understand what's going on. Follow your system. You should have no opinion. No one understands these things and what makes them tick and what's going to happen with them. So it's the perfect market for me, as long as it's liquid, as long as it delivers some diversification, which it does. And so I like them. They're great. I hope I have a fifth sector: currencies, commodities, stocks, bonds, crypto. That would be a nice addition to the portfolio over time.
Going back to your original idea that we talked about speeding up your signals, like after 2020, do you have to speed them up for Bitcoin? I mean, it would seem like, the longer term signals wouldn't work very well with, Bitcoin and Ethereum futures, but maybe I'm wrong about that. I mean, can you use the same system there, or do you need a new system?
No, I use the same system. I think looking at the markets as that all the price patterns are sort of governed by human beings, and it's humans interacting with these markets. It's not the market itself. It's the way people are dealing with markets, with hope, fear, and greed, not wanting to take small losses, not wanting to let profits run. Trying to optimize and fine tune. I think it's perfectly fine. And like I said, my strategy is more long term. But look, there's at least two parts to these trends. Yes, of course, the one part is the crashes. And so Bitcoin has had some crashes, let's say. So you gave back a lot of profit. But in Bitcoin and in a lot of these markets, most of these markets, they're so choppy. And you need to have what we call loose pants, where a lot of scenarios can fit underneath your parameters and not continually get you, out and have to get back in. So I think that that's your first thing that you must accomplish, is having parameters that don't keep you in a era where, not like the 70s when it was smoother trends. They're very choppy and they're very volatile. and everyone gets overly optimistic and pessimistic, only to see the market go right back to new highs within a few weeks. And so it plays havoc with having to rely upon that same parameter to get you out of the trade when the trend really does turn. But once again, that's the world we live in now.
Just two more questions, and then we'll let you go. This has been great. But if most of the people that watch our podcast, I would consider them more advanced.
No, I say take off your shorts. Take off your shorts.
Active investors or professionals. But for the more advanced DIY active investor or trader, what resource or resources would you recommend someone go to learn about trend following?
Oh, wow. I mean, think about it. I mean, I aced that test and there was no internet around. What was I reading? The internet is just so full of the turtle systems, the basic money management, and how what we were taught. So many great people on Twitter, Twitter Spaces. I run a Twitter Spaces every Friday morning at 8 o'clock.
This is what I was telling you guys at the beginning of this, right? If you're in 2025 and you are still not listening to the fact that we have the greatest traders in the world voluntarily, free of charge, providing you as much information as they possibly can, and you are choosing to ignore that and say you know better, you are so toast. Me, Minervini, Jerry Parker, tons of people put out amazing content for free on the internet. Not that you're already listening, but there are so many people with their head in the sands who don't want to listen to anybody because they think they know better. And you don't have to pay $84,000 a year to anybody. There is plenty of amazing content on YouTube, and I hope that I can be one of those places where my free videos are better than most people's paid courses. But if you're not listening, I can't help you.
Podcast, Top Traders Unplugged, so much good trend following information out there in the podcasting and on the internet, in the media. Andrew Beer, and so much going on, especially this year. But it's just overwhelming how much information is out there for people. Honestly, yeah.
So we like to ask our guests sort of a standard closing question, and that is, if you could teach one lesson or impart one piece of wisdom to your average investor based on your experience in the markets, what would that be?
Well,
this is good. All right, y'all be ready to take notes on this. What is your number one thing you could teach people?
So many, I could say. I did tweet a quote from Soros today, and it's one that I have believed in for many, many years, and that is, don't be skeptical. Don't be skeptical. Buy the breakout and look and get in here with the trend, and don't be afraid to add markets that don't make sense. I mean, I was so negative on the iPhone when it first came out. This is not going to be anything. And how dumb is that? You should have this attitude of a child and believe that it could be something. You never know. It really is just a twist on, you're going to have a bunch of outlier trades that could make you 1,000 or 5,000%, and then everything else will be pretty much a break even or a loss. But just, attack your investments and your life in that particular way, that you want to be on board with crazy things that probably won't happen. But every now and then, Bitcoin comes along, Apple comes along, and the great things about life, the technology comes along, and just embrace it, make a small bet on it, and follow the trend. And don't be too hesitant to get out of that trend and hold on. But don't overanalyze. Even the best people cannot predict what's going to happen in these markets. And the best way to attack the markets is through a systematic rules-based approach that basically says, I have no idea, I'm just going with the trend.
And that's what I like to tell you guys all the time, right? Is that, let's say you're using the 10, 20, 50 rules, right? There are times, and he said, approach it like a child, right? Approach it like, hey, this could work out. It might not, but well, it might, right? You put on the risk and it might work out, and then it might not. You might lose a buck or make a buck, right? But one of these trends will run, and you're going to be like, oh, wow, now I get it. Now I get it, right? You might make a buck or lose a buck every now and then, but when they work, because you were there to make sure that it didn't leave without you, you got paid so much in a single move. And then you might make a buck or lose a buck, but then you didn't get hosed on the way down. You weren't the mayor of Bagholder Village. Isn't that cool? Right? I'm not telling you this. Jerry Parker's telling you this.
Thank you very much, Jerry. This has been, I think, educational, fun, and I personally like your philosophy and outlook when it comes to investing. So we appreciate you spending time with us and joining us. If people want to learn—
oh yeah, there we go. So listen, I'm so stoked that we got to do this. I know it went long today, and I told you it would, But is it not worth your time to listen to somebody like this? Is it not worth your time to make sure that you are learning from the best people who have made money in the markets rather than, your guy at the local mechanic, right? Maybe your brother-in-law, maybe somebody you met down the street, maybe somebody at your kid's soccer game, right? Wouldn't it be better to learn from somebody who understands how the market works? I think it would. So I think it was definitely worth our time. Now, I think it'd be worth your time to click one of these two videos that YouTube's popping up right now.